The Taiwanese index, like you can see, seeing a cut of almost 0.5%.
For the last 2.5, 3 years, we've been very positive on a lot of PSUs.
The up move, I mean, broadly, if you want to look at what are the levels we are talking about here, we left off at 22,200. There perhaps is another 300 odd points or so based on Fibonacci extension levels.
They are denying any such involvement or any such talk to revive the deal with Sony.
This tells CNBC-TV18 that Union Bank of India has launched a QIP.
Galco's Novelis will be one of the largest listings in the overseas market by an Indian-owned company.
The Nifty is starting about what? Absolutely flat, nothing. 8 points or so is what you have on the Nifty.
In India, for our stocks under coverage, earnings are growing around 23%.
India has seen one of the best earnings growth amongst all emerging markets as such.
It's a 6-point up move on the Nifty right now. Sensex up 30 points, absolutely flat.
And what we are hearing also from the sources is that it could see an increase of nearly 8%, which is 25 rupees per quintal as well.
We are in the heart of India and we are in the heart of Delhi.
You know, just in the last half hour, I've seen a bit of a sell-off and the market's now trading near the low point of the day.
All right, well, you know, that's a day so far, but the point is the day so far would not have told you what's come our way in the last 30 minutes or so. That's the point. Because the screen has turned, the market's no longer up, it's no longer even flat, it's down 3 digits, 100 plus points. You're with us here on Closing Bell. We're coming to you from CNBC-TV18 Motilal Oswal Studios. I'm Prashant. With me, my colleagues Reema, Surabhi, Nigel is joining in as well. Guys, hi, good afternoon.
Hi, a sudden turn in the markets, 130, and it's not nosedive, it's not a deep correction, but there is a turn in the sentiment.
No, absolutely. There is a turn in the sentiment. And, you know, you've got the Nifty, which is down 120, just to kind of look, take you through. Look at that. The fall from the high is a full 170 points. Now, that's not sort of small. The small cap index is the one which is sold off the most. You know, that index is down full 0.75% on the day. Of course, from the highs, it's even more. And the advanced decline, which at about, what, even 215, the fall started at 140. Exactly 140, the market started to fall. But the market breadth held on till about 10-15 minutes back. And that's also now more declines as compared to advances right now.
Absolutely. And it's actually across the board. Barring two big banks, SBI and ICICI Bank, by the way, they still haven't caved in. And you have the metal stocks, and metals rally has been on since morning, and that's still intact to a large degree. But if you go beyond, let's pull up the contributors. A lot of the fall has come in because Reliance has decided to change contours. Reliance was nicely cruising along in green till not too long ago, but now that's a stock that's exerting downside pressure. There's TCS that's taking things down. L&T is the other one. So that's where the pressure points are. Just to talk about the biggest losers right now, a lot of the PSU stocks, the larger PSU stocks like BPCL, Coal India, Power Grid, NTPC, a lot of them are seeing money come off the table. Not much, just 2-3% decline, but they are seeing some pressure today. Nigel, lots happening.
Well, that's right. Quite a bit happening out there. It's been a bit of a U-turn or a bit of a shakeout, so to call it. But let's get in our guest then on the show. I think we have Srikanth who's joining in today. Hi, Srikanth. Good afternoon. Good to see you in. What do you make of this U-turn? You know, there are some nervous signs coming in on the geopolitical front, and I think that's getting the street a little bit nervous as well. What's your take on the Nifty? Do you think we're in for a bit of a correction, or do you think we could see a bounce back from here?
Yeah. Good afternoon, Nigel. I think, if we go through with the global macros, then yes, certainly they were not at all favorable for emerging markets, and maybe that's the reason we are seeing some upside cap for the market. After hitting the levels of 22,250, the market is correcting, but I think 22,000 is something which is certainly going to act as a major support for the market. So maybe 50 points here or there, but 22,000 should act as a very good support for the market. And after hitting those levels, again, I'm expecting market to rebound to the levels of 22,000, maybe 300 or 22,500. So close to 22,000, we should look for taking some contra bets in the market. That's the overall strategy. For Bank Nifty also, we are seeing some correction, but close to 46,500, I think the Bank Nifty should stop and reverse.
Okay, Srikanth, in terms of individual trades?
Yeah, the way we saw some activity in metal stocks, and most of the stocks have broken their immediate highest levels along with good volumes. But yes, the market is not that favorable. But otherwise, if we see the pattern of Tata Steel, then I think it is heading for the levels of at least 155. So at current levels around 144, 143, it's a buy with a stop loss close to 141. I'm expecting stock to move towards 155. And the other stock on which we are specifically bullish is Reliance Industries. The reason is because it is holding well above the mark of 2900. No doubt that the market has already corrected, but in case if we see further more weakness, then close to 29.25, 29.30, we should look for taking some buying position on Reliance Industries. This stock can go to the levels of 3,000 or maybe beyond. So Reliance is also a buy with a stop loss close to 2880.
Okay, got that, Srikanth. Thanks very much. We'll come back to you in about half an hour and try and get some more perspective on the market. By the way, I should just mention here that global markets are also a little volatile today, and US futures in particular are down. NASDAQ futures, to be more specific, they're down about 0.5%. Market seems to be a little jittery ahead of those big numbers from NVIDIA, and the scope of error obviously is very, very minimal. And I guess that's part of the global narrative. And we've had HSBC numbers in Europe just a while back. They've written down quite a bit of their investments in China. So, I mean, maybe it's some excuse because of global markets being slightly volatile too. We have Prakash Diwan on the show today. Prakash, good to have you on as always. You know, the first stock we want to talk to you about is ABB. We'll also hear from the management in the next couple of minutes. But good earnings, and what a spectacular salute the market has given the stock today.
Oh, absolutely. Good afternoon, Surbhi. So, before I speak about ABB, just wanted to share with you anecdotally. I was speaking to some people today, and every time the market in India goes down, we start looking for excuses or reasons to attribute to the global side. And when it does well, we have so much of internal enthusiasm to talk about. So, the market is telling you that we are at that spot where the vulnerability is quite high in certain overbought pockets, so you need to take that with a pinch of salt. Yeah. So on ABB, I think what is very commendable is the fact that in spite of having got the focus only on a few of their strength areas when the demerger happened, post that, if you see the kind of run, they've deepened their product mix and the client relationship to such an extent that the margins have improved dramatically. I mean, the kind of margins they've clocked, and for the entire calendar year, if you look at the performance, the revenue has been far better than what they guided in, and there's still an order book that looks so promising. So, that's the reason why the market's not just like the numbers, but also going forward, the kind of potential that it has to continue with these kind of superlative metrics. So, I don't see any reason why anybody would want to get out of the stock, book some profit so soon.
In fact, it's a good time then to invite the management of ABB. In fact, the company, the top management chatted with my colleague Vivek. And just to refresh your memory, ABB reported very strong numbers. Q4 calendar year 23 numbers were ahead of street estimates. The Q4 revenue growth is the highest that we've seen in the last 5 years, a growth of close to about 14%, record high order wins too. Listen in to that conversation Vivek had with the management.
I think it is the continuation of our business engagement strategy for India. As we explained to you when you visited us last time in Pune, Bangalore. Herein, the 18 business divisions which operate for us in the country, they engage in 23 market segments. So one is that we continue to make our portfolio broader. We continue to localize it. We continue to engage even deeper into the market segments we have identified, which are relevant for us. And also in the geographies, we are doing even higher penetration in the unserved market. So that's the combination which plays for us and works for us.
Mr. Sridhar, let me come to you now. At the start of 2023, we were working with three numbers. We were working with a revenue estimate of 10,000 crore, a gross margin in the range of 35 to 37%, and PAT margin in the range of 10%. You've handsomely exceeded all of that. Going into 2024, what are the targets you're setting? And also, would you agree that gross margins have peaked out, most of the operating leverages have played out, and we can maybe accept some softness going ahead?
Thank you. Thank you, Vivek, for this interesting question. I think every time you meet me, you ask me the same question. So I think ABB for 2023, as you rightly mentioned, has delivered a strong result from what it was in 2022. right? So I think the gross margin at this point of time is excluding the material cost is holding at 35%, right? So we are now around 63% on the material cost, and hopefully I think a range between 63 to 65 should be an acceptable range, considering the fact that we have a backlog which consists of a good mix of project orders, service orders, as well as product orders. So I think that's something what we feel is a good area for us to keep improving, doing localization, taking leverage of the capacities what we have, and of course the optimization actions and the localization initiatives what run quite substantially within the organization, the different 18 business units, as what Sanjeev was mentioning. So I think this pursuit of excellence in these topics will continue, and we are confident that this will help us to remain steady in what we are in the range where we are today.
Would you be able, or have you guided the street for a specific set of numbers to look out for in 2024?
Vivek, as you know, we don't give any forward-looking numbers. So we only give a directional view about it. And so that was what I was mentioning about in my last
Can understand that, sir. Sanjeev, sir, coming back to you. Now you are sitting on, what is probably a very, very strong order backlog. Give us a sense of the order mix up. We understand that some of the orders that you're sitting on are slightly higher margin orders. We also understand that you've done some premium pricing in some of the projects that you are present in. So give us a sense of, the orders segmentation in terms of short cycle orders. Last quarter, there's a bit of softness over there. And also, how's the export market looking like?
In our books, we have seen booking of some large orders, especially coming from railway market segment. And with the result, and also in certain process industries, with the result, what we have is our traditional mix of 9% of projects order has moved to about 15% of our books. So that's a kind of a change that you can see from the mix from our ETO business, which is engineer to order, and stock to STO and the other type of product business that we have, product business mix we have. Services business stays steady and they are growing, and also our export business has grown in value terms, but in percentage term it looks dwarfed because the domestic growth is much stronger for us.
Mr. Sridhar, one more number. ABB Global, when they declared their results, they said that India is growing at close to 16%. But if we see your own order backlog growth or the order inflow growth, it's much higher compared to that. Can you explain the differential to us? And also going forward, is there an expectation that there may be some moderation as far as order inflows is concerned, especially against the backdrop where we will see the election code of conduct coming into play?
Okay. So I think, Vivek, so how does ABB globally look at India is how much do they source into India? So that's basically what is the parameter is what you say. That means whatever imports what we do from India, right? For India, for production of India, and also for the direct orders what goes into the global market through for exports is something what they look at, and that is called as a demand view. A demand from the country for ABB products is what is basically they sum it up and see how is the 16% growth. But when we look at it, we look for those which we are servicing in India, right, which are just not ABB product solutions. We also have other products which we factor in and give it. So it's a more of a local demand as what we are talking of, right? So that's why you have a global giving a number of 16%. And when we see, which is called a supply, which is basically supply into the country, we'll talk of 23%, which includes both the local demand and the exports what we are seeing.
All right, that's the management of ABB India talking about how they see business shape up at the end of what's been a really good quarter. We'll take a break on that note, come back on the other side, and Ajay Vora of Nuvama Asset Management is going to join in.
Welcome back. The sell-off is deepening now. It's 162 points lower, and from the day's high, it's a lot more, close to about 220 points gone from the session highs. The Nifty is down 160 points. Keep your eye on some names where the selling pressure is picked up. ONGC is down 1%. Adani Ports, Eicher Motors, Adani Enterprises across the board. Power names are weak. IT is selling off. Tech Mahindra is down close to about 2%. And Coal India continues to bear the brunt of selling pressure. 3% gone today. And this week itself, in the first 3 days, Coal India is down close to about 10%. But the losses are being led by the oil marketing companies. So BPCL is the top laggard on the Nifty, 3.5% gone on that. Vivek is here with us. There was a recent note by Spark where they've downgraded oil marketing companies. Vivek, we've had a slew of upgrades, and this appears to be the first downgrade that we've seen on oil marketing companies. Is it just the valuation, the run-up?
Well, absolutely. A lot of interesting points that, Spark has mentioned. So, number one, like you mentioned, quite a lot of upgrades on the street coming in as far as OMCs were concerned. Along with that, remember, very large new fund has actually come in as far as the OMC or the energy space is concerned. So, SBI Energy Opportunities Fund, they were looking to raise just close to 4,500 to 5,000 crores, managed to garner well over 6,000 crores in this new NFO. And what does the scheme say? The scheme is actually that they would largely be investing in the oil value chain, that is both upstream and downstream, new energy, power, as well as power infra. So that has also been one key trigger as far as the entire re-rating in the space has been concerned. But today, Spark Institutional Equities, has actually looked at both the fundamentals as well as the valuations, as well as the stocks run-up that has been seen in the recent times. They've turned negative on OMCs. They have a reduced rating on BPCL. They have sell ratings on both HPCL as well as IOCL. They're saying that the global disruption-led diesel as well as GRM spikes at this point of time is not sustainable. Remember, diesel cracks are at an all-time high. They're also saying that multiple data sets that they've been tracking indicate that easing diesel supply and in turn, on back of that, cracks could revert back to the $20 per barrel mark. They're also saying that the maximum impact as far as the Red Sea disruption is concerned is already in the cracks, and on the back of that, you would see that receding further. They believe stocks are now pricing in $9 to $10 per barrel worth of GRM for FY26. At this point of time, risk reward is not favorable.
Okay, interesting. So we finally have a bear as well. Lots of bulls on OMCs, but we've got that bear call coming in as well. Vivek, thank you very much for that. Prakash, let's toss it to you. Which camp are you in? Bear or bull when it comes to oil marketing companies after this big rally?
No, I think we need to be nimble enough to do both the things. But at this point in time, I think the OMCs are moving from that extreme pessimism or absolute ignoring the market, ignoring them, to certain realization that there's so much merit. But then we've probably done it too rapidly. So some profit booking is par for the course. I would believe it's an opportunity for long-term investors to get in if you see a bit of softness in the stock prices, where the business profile hasn't changed dramatically. And these rates, whether it's crude, whether it's GRM, all of those are dynamic enough, they will continue to change. So it's not something that you can take those for granted, but the business model still leaves a lot on the table in terms of what value they could create and at what price they are available. So I'm on the camp that it's still a buy on dips for me, but particularly I like IOC out of the three. And I keep on saying it's the gas value chain, which is also seemingly very promising, and you could probably dip in out there as well.
Okay, all right. Hi, Prakash. I wanted your view, Prakash, on Hindalco. Kabhi kushi, kabhi gum, right? On Hindalco. A few days ago, there was a shocker coming in on the capex. Now they're saying they're going to do an IPO. The street actually is confused on Hindalco. Otherwise, the stock should have definitely been up by 5 to 6% on. It opened up 5%, and from there it's being selling off because the street is wondering, why are you doing this IPO at Novelis? And the money is going to come back to Hindalco, which doesn't need the money because their capex can be funded by internal resources. There are a couple of, school of thought out there. One is maybe they pay dividend, but that will not be very, very tax efficient. Second factor is they're bracing themselves for bigger competition in the space here in India. So they're bracing themselves on that front. And the fear is maybe it goes to a group company like Vodafone Idea. Hopefully that doesn't happen. Your view on the stock, though, at around this $510?
So I hope the last option that you mentioned, a possibility, is just an impossibility. It doesn't, because that would be devastating for the Hindalco balance sheet. But interestingly, I think if you understand the fact that there are some of the largest names from corporate India who are putting their weight behind copper, and not necessarily aluminum as much, but some of these businesses that have almost been monopolistic or duopolistic for Hindalco in India, they will need to shore up, they will need to scale up. Now, what they do with the money is subject to what kind of money actually finally comes through. So I think it's just an intent, and it could probably be their way of gauging how things look up. But I don't think it's going to be a bad idea. In fact, the street overreacted to that story when they explained that they would turn profitable from the second year onwards, though the investment is significantly higher in the first year. And the scale that they're looking at, Nigel, is something which is going to make them very, very powerful, very dominant in that space after 2 years. So if you have that kind of a long-term vision, then of course a lot of things will start falling in place and they will deliver, they will outperform. It's a great pedigree business. But these short-term moves probably are on the basis of expectations not being in sync with what the management has been deciding. And a lot of these things have come very unexpected. Nobody expected the capex program to be outlined with such quantum. Nobody expected the Novelis IPO possibility to become real. So all of those things have been without expectation, and that's the reason why stock is reacting. I would believe at 510, 512, whatever zones it is, it actually offers a great entry for long-term investors. There might not be immediate gains, as I said, because everything that they've disclosed, they've shared, is going to translate into numbers much later. But the space is promising. You don't see, look at who all can come into it, and there's virtually nobody that you can think of with such scale and such might.
All right, Prakash, we'll leave it there. Thank you very much for joining us. It's a pleasure having you with us here on CNBC TV18. Well, 160 points lower is what we have, 22,040. Ajay Vora is head of equities at Nuvama Asset Management. He's joining us now. Ajay, good to have you with us here. Thank you very much for your time. At the margin, I mean, actually, there is an underlying sense of unease with the big rally that we've had. Everyone, of course, wants to stay long. But when you talk to many, you get that sense that, you're along for the ride. But at the same time, there is a sense that maybe, a pause, some consolidation perhaps would do more good. Do you think we are at that point now?
Yeah, hi, Prashant, and thanks for having me on the show. I also, to a very large extent, agree to what you're saying. I think we are due for some sort of consolidation. The rally has been, broad-based across large cap, mid cap. And most importantly, if you look at it, there are two big trends which I feel that, if the transition takes place, then there can be some sort of consolidation or pullback. So one is globally, if you see that, we are the third best performing market post Japan and NASDAQ, so which are both the developed world markets. And most importantly, within emerging markets, if you look at it, now we are looking extremely expensive. So if money has to move to other emerging markets, there can be some sort of shift from India. And then if you look at, local markets, meaning our markets, Indian markets over here, if you look at the high quality are looking now, reasonably priced, I would say, in terms of the time correction which they have gone through. And also, if the earnings continue to be positive, meaning in terms of strong growth, then, the large mid-cap kind of names, the kind of rally which they have seen over last, maybe I would say 3 to 6 months, they are looking a little more expensive versus the quality large cap names. So I think that if the trend really shifts on both these fronts, there can be some sort of, pullback in the near term.
Ajay, hi, good afternoon. Just give us a sense on where we stand at the end of the quarterly report card, because I was going through the report that you folks had put out just a couple of days back, where one of the trends that was highlighted was that the EBITDA line, the growth at the EBITDA line now seems to be converging with the kind of growth that we were getting at the top line. Basically, whether we'll keep getting as much a margin kicker in earnings as we were getting in the first half of the year. And the note here says that this perhaps could pose some sort of a risk to the 15% growth expectation for next year. Just expand on earnings and where we stand, especially for the broader market, not so much the Nifty 50 perhaps, but what you've seen in terms of the deliverables at the end of Q3.
Yeah, sure. So, largely, if you look at the way earnings have panned out, and I'll talk about, Nifty earnings as well as the broader market, it has been, last 3-4 quarters, we haven't seen at the aggregate level any sort of downgrade at the aggregate level. So some of the other sector has contributed. And if you look at, this quarter also, you'll see significant upgrades, first of all, coming from the oil and gas energy space. Then it was autos, cement, and to some extent, even metals. So there has been some sort of, disappointment on the banking side, but all the other sectors actually contributed quite a lot. Something like, Tata Motors on the auto side, within metals, couple of names. And as we all know, the oil marketing companies reported fantastic numbers. So in a way, if you look at it, last 3-4 quarters, some of the other sector has contributed in a big way, and therefore we haven't seen any kind of downgrades at the aggregate level. Now coming back to the broader market also, you will see that the discretionary side of the space or the pockets hasn't really fired, and that has been a big disappointment over last 2-3 quarters. But on the other hand, the whole capex and the investment sectors, investment-led sectors, they have reported fantastic numbers both in terms of top line growth as well as margins. So which we strongly believe that it is not sustainable over next 3-4 quarters, and therefore considering what we spoke earlier, I feel that markets will look for a major upgrade from here on to rally from the current levels. And that I think will happen only after a couple of quarters when we see the whole consumption side of the basket picking up. So margins are at elevated levels right now because of lower commodity prices. So if you look at most of the base metal prices over last 1 year, they have been down close to 10 to 15%. So my sense is that even if that normalizes, the margins have peaked out to some extent on the capex side of the businesses. So therefore, for the next leg of an upgrade, we need to see the whole consumption sector lead it, and then we can see that particular pocket performing well.
Okay, all right, Ajay, just hold on to that thought. The 22,000 mark is getting breached as we speak. The big boys in there actually are seeing quite a bit of profit taking. Coal India is under some pressure. The stock is down close to 3%. JSW Steel, put up the intraday chart out there. That stock has done a quick U-turn of sorts. So intraday chart of JSW Steel comes up, and ONGC is another name that has seen a bit of a dip. But Ajay, there are times of volatility, times of correction where you get to buy those stocks that you are looking forward to. I think a couple of months ago we spoke about Glenmark Pharma, if I'm not mistaken, and that was one stock that you liked. Give us a couple of names. If the market goes through a phase of consolidation, maybe the headline index pulls back 5% odd, what would the stocks you'd be looking to buy, if you could name a few?
So I think one space which is still looking attractive both in terms of valuation and growth is definitely the whole banking space. They have underperformed quite a lot, and rightly so, because of the concerns on the whole NIM trajectory, on the concerns of overall, the liquidity factor, what we are seeing in the system. I think going into election and post that, once we see system liquidity easing a bit, I think that the whole concerns on the loan deposit ratio and therefore NIMs will ease off. And then if you put the numbers and look at the valuation for most of these banks, they are trading, I think, below mean valuations. So my sense is that in any sort of correction, one can look at banks, because eventually if the economy has to grow at around 12% nominal GDP, I think the system credit growth will continue to be pretty strong. And eventually all these banks will end up doing pretty well. So my sense is that most of the other sectors, not all of them, are to some extent fully priced in. If you look at something like a pharma or an IT, to a large extent the valuations are very much there. But banking is still one space where the valuations are looking pretty reasonable, and it has underperformed quite a lot, I think, over last 1 or 2 years.
So you're comfortable with banks. Many of the high valuation sectors and stocks can continue to remain expensive and trade at premium valuations on account of high earnings growth and confidence that the earnings growth will sustain. Where is it that you're uncomfortable right now and you will not hold it or recommend holding it in your portfolio, where the valuation is not justified?
Yeah, so Rima, actually, if you look at it, the whole capital goods sector, if you look at it, the way government was spending money over last 3-4 years, and even if you look at the budgeted numbers, the CAGR was somewhere in excess of 30% over last 3 years. And although it will continue to remain strong going forward, but that whole number, the growth factor is what matters at the end of the day in terms of the order inflow. That is coming off, that is expected to come off a bit from 30% to, I would say, closer to 14-15%. And then if you do the valuation for all the large cap or even the mid cap companies, these companies are now trading somewhere close to, I would say anywhere between 50 to 60 times PE. So I think that, some sort of adjustment either in terms of price or, time is needed for that particular space. And therefore, I think that, we are not buyers at current levels into that space.
Ajay, we were just having this debate with our previous guest on oil marketing companies. I'm just taking that as an example because that was the last leg of the PSU rally, right? We've had railways, we had defense, and then you had the market latching onto OMCs. Do you think this is just an extension of the PSU frenzy, or is there real merit in continuing to expect elevated refining margins and elevated marketing margins for these OMC names?
So, Surbi, I think that, I was on your show a couple of months back, and we were extremely positive, and we were fortunately pretty early in identifying that trend. Even at that point of time, as we had discussed, most of these names were available at below book valuations. And most importantly, the street estimates were significantly lower versus what these companies could have reported. So if you do the numbers, most of if you just take an example of, IOC, now they'll end up doing somewhere close to 50,000 crores of EBITDA ballpark, which earlier, market was expecting it to be somewhere around 35,000 crores. So there has been almost 50% upgrade in terms of the estimates. And then actually, if you look at it, they were trading below book. Now they are trading more or less, I would say 1.3, 1.4 times price to book. So therefore, we have seen this kind of, returns where stocks have doubled, both in a combination of both, the 50% earnings upgrade as well as the valuation, coming back to the mean levels. So I think that, the story is still looking better, because if you look at the cracks, the refining cracks for diesel and, gasoline and all, they are still pretty strong. And going into the election, if you don't see a major revision on the pricing side also, we can have very strong marketing margins. So considering 100% rally in all these names, some sort of consolidation or pullback is very much needed. And as we all know, that market eventually gets very heavy in terms of positioning where the momentum is. So I think there can be some sort of adjustment to that positioning. But if the cracks and the marketing margins stay healthy, I think the stocks are still looking, we are still positive in any sort of correction in these names.
Okay. All right, Ajay. Thanks very much. Good to have you on the show and good to get that perspective. I'm just thinking, guys, to his point on marketing margins and how the policy will play out before elections. Coming to think of it, this government, it hasn't done anything which is usual, just, pre-election. Nothing on income tax in the budget. Not even an extension of the PM Kisan, the big numbers that were being widely anticipated. I don't remember the last time we had a petrol and diesel cut. So who's to say? But I guess interesting times to watch what happens on the fuel pump side as well for these stocks.
No, absolutely. And maybe, as he said, right, for once stocks come off, shake off a little bit of excess positioning, etc. But the story is there. It's not as if, they were all built up with nothing. There are reasons why the stocks are re-rated. And the pullback is possible. That's something which would be par for the course, and that would shake off weaker hands, etc. But if the underlying fundamentals are there, they'll pick up once again. So stocks are on your screen. But I think what Vivek also was pointing out, that's that Spark, a vendor's note today, that's the first downgrade for oil marketing companies, which has come through after a slew of upgrades over the last so many weeks now. Nigel, you want to come in?
I think we just need to take note of the flashes that are at the bottom of your screen. CERC on power exchanges, they have directed the audit of processes and software of 3 power exchanges. So it explains why IEX has suddenly taken a sharp downtake. The audit should be completed within a period of 6 months, and they've observed a few instances of mutual entry of bids after market hours. So it seems, as it is, there is some uncertainty with regard to market coupling. And now, in fact, this could be an incremental negative that's come in there. So it explains why IEX, results, I think, are down close to 1% or thereabouts. It's taken a further leg down because there's incremental negative news that's come in on IEX as the market awaits the outcome of market coupling. So just thought, while we're discussing some of those OMCs and oil and gas stocks, IEX should be the stock as well that we're focusing on. We'll try to get you further analysis on this. But for the time being, that's the stock in focus. Let's do one thing. Let's slip into a short break. You come back, we'll continue our focus on markets and on stock-specific action. Don't go anywhere.
Well, this is a choppy market, and it's telling you that there are buyers at every dip. It's not like it's a one-way move. Pull up the Nifty intraday, by the way. After almost breaching 22,000, there's a 70-point up move as well that you're seeing from the bottom. So, it's moving in between parts. We still have about 20 minutes of trade left, so let's see how it goes. What's also interesting is the PSU index today. Whether you're looking at the Nifty PSE or the CPSE, these indices are still nursing cuts of around 2.5%. And it's across the board, some of the mid-cap PSUs as well as the large-cap stocks. So that brings us to the CNBC-TV18 exclusive. Rajiv Jain of GQG Partners he's of course one of the largest foreign investors in India at the moment. And in an exclusive chat with Prashant, he explains his thought process on PSU companies and stocks. Remember, GQG holds meaningful stakes in NTPC as well as SBI.
We looked at the oil names, and if they were more liquid, larger liquid, probably would have bought them because for the last 2.5, 3 years, we've been very positive on a lot of PSUs. I mean, include State Bank of India, NTPC, Power Grid, and we own in some small and large way. I think some of these are basically look at our size and scale. We can't execute because sometimes blocks are not available. By the way, LIC is the same one. We would have loved to buy that. We couldn't find any blocks last year, early last year. So I think some of these are just hard to execute from our vantage point because we like to run very constant book. But I think one thing which is, and these were not simply cheap. What we saw was just much more tighter management. I mean, if you look at NTPC, we quite like how the current management has done a much better job versus historically. So there's this sense of urgency you're seeing in a bunch of these, and I think they're also getting a lot less intervention from Delhi, which was a chronic problem historically, right? So in last 10 years, the intervention has gone down dramatically. In fact, they pushed to hire some very competent people. A lot of a lot of these companies. So I think long term we like these, but obviously today a lot of them are done well. We still like them, but our problem sometimes is that we like to run constant portfolio and just hard to execute because those blocks are hard to find. But otherwise, I think, and as you know, these things are very under-owned by vast majority of foreign investors too, because there's this perception there that state-owned companies are always bad. Nothing is always bad, and nothing is always good for that matter.
Well, interesting conversation between Mr. Jain and Prashant. Make sure you catch that. You will be playing snippets all through the day. Well, let's get in Hormuz. Hormuz is here to talk about Whirlpool, which has been a rank underperformer. The financials as well haven't been improving much, but mutual funds have been tanking up. Hormuz, get us this piece.
It's not a stock we talk about very often, but then that's where the stories lie, don't they? Now, Whirlpool shares have been underperformers over the last few years. Now, in fact, if we take the last 5 years, 4 of them, including the start of this year, have all delivered negative returns for the stock. And that also comes on the back of sluggish financials. Now, Whirlpool's revenue growth is almost stagnant. Now, if you take a look at the last 5 years in terms of the revenue growth, from around 6,000 crores that it had in FY20, the FY23 revenue was also around 6,600 crores only. Now, the revenue growth is almost stagnant and margins, on the other hand, are dwindling. Now, if we take a look at the margin picture, the EBITDA margins of FY19 of 12% are now down to 6% by the end of FY23. Now, moving forward, but despite this sluggish financial performance, the company continues to command a lofty premium. Now, we highlighted this yesterday as well, that the stock is trading at an FY25 price to earnings multiple of 43 times. Now, financials are on a shaky wicket, valuations are elevated, but what do mutual funds do? They buy more. Let's take a look at that graph. Now, in March of 2019, India's mutual funds had an 8% stake in Whirlpool, which remained around the same levels till the December of 2021. Now, since then, there has been a consistent increase in mutual fund ownership in Whirlpool, and as of December 2023, mutual funds own around 11.1% stake in the company. So, who is the one who's holding the stake in Whirlpool? Now, as per the shareholding pattern, Kotak Emerging Equity Scheme had a 4.4% stake in the company, followed by funds like SBI, UTI, and Aditya Birla Sun Life. Now, that 11.1% number is set to go further higher after yesterday's block deal, where 24% of promoter equity changed hands. Now, they were the sellers there, and SBI Mutual Fund emerged as the top buyer in that transaction, picking up a 7.2% stake and has now become the largest public shareholder of the company. Now, other buyers in that transaction included Aditya Birla, Society General, Nippon India and DSP, all of them picking up a 0.5 to 1% stake in that block deal. Now, the stock over a 5-year period is flat, and the same goes for the last 12 months as well. No movement at all. Now, in comparison, most of its peers, barring Symphony, have done well. Yet, on the valuation front, Whirlpool is expensive compared to most of them, barring Havells. So what lies ahead for Whirlpool? The company has laid out a plan to revive its sales growth through innovation, improved visibility, premiumization and other steps. The management has also given a long-term guidance of a high single-digit revenue CAGR and a high single-digit PBT margins. Now, Kotak Institutional Equities in a note earlier this month wrote that the street will have to assess the multiples at which the stock is trading. That's Whirlpool for you. The stock has been in snooze mode for a while now, but India's mutual funds are hoping that the machine will wash away all the underperformance sooner or later.
All right, that's well put, Hormuz. Thanks very much for that. So we'll see if that bet works out or not, but there is enough demand from local institutional investors, as Hormuz points out. Well, Shrikant Chauhan is with us now. With the trades? By the way, the markets posted a very sort of respectable recovery, 100 points, by the way, approximately 100 points from the day's low, which means we are left with a 100-point cut. 22,091 is where we are at. Now, Shrikant, good to have you with us here. Thanks for your time. Just a quick view on the index, the price action we've seen in the last 1.5 hours, and your trades.
Yeah, Prashant. I think, the market is finding support, or whenever there is any correction in the market, we see buying around those levels where there is huge amount of put writing or call writing. So today, after hitting the levels of 22,300 or 22,250, we saw correction. But at the same time, there is huge amount of put writing at 22,000 levels. And from there, we are seeing now recovery. So maybe again, we may see the levels of 22,200 in the best case scenario. But now till the markets are not crossing today's highest levels of 22,000, let's say 250 or 300, we are going to see some consolidation in the market. So that's the reason, again, we need to be more and more stock specific. For the Bank Nifty, it is not correcting at all. It is, in fact, holding well above its day's lowest level, which is positive. I think we should look for taking some bets from the Bank Nifty or from the BFSI sector.
And any BTST calls?
Yeah, I think at this levels, we should look for adding stocks like IndusInd Bank. The reason is because the stock has formed double bottom sort of formation close to 1430, 1440. And in this particular correction, when the market was correcting from the highs, the stock was holding well above the mark of 15, 20, 25, which is an indication that the stock is outperforming or it is relatively stronger than other stock. At this levels, it's a buy with a stop loss at 1480, which is a stop loss of 40 rupees. We can again expect 1580 or 1600 on the high side. So IndusInd Bank looks good to buy at current levels. And we also like Ambuja Cement, which is very close to its previous highest levels of 598 or 599. On the dismissal of that, I'm expecting stock to move towards 620 or 630. And the stock has spent a lot of time close to these levels. So at 590, it's a buy with a stop loss close to 580. We can expect 620, 630 on the high side.
All right. Got it. Shrikant, anything happening? Paytm is bouncing, at 20% or so from the lows. Anything happening chart-wise here in terms of price action?
In this fall also, Prashant, the stock has broken its previous lowest level, which is something negative for the stock. And till the stock is not crossing 530, which was its immediate swing highest level, I think the stock is going to remain under pressure. So yes, after hitting the very extreme levels, a dead cat bounce happens. But if it crosses 530, then only we can say that, okay, the stock is stabilizing. Otherwise, I'm expecting stock to remain within the range of 550, 530 on the high side and maybe 350, 330 on the downside.
Thank you very much for that. Appreciate it. So 530 or so is that marker which Paytm needs to cross before we look at further gains. We slip into a quick commercial break here, but here's an interesting chat with Siddharth Boya of Equitas on how to approach the markets on our special podcast offering, My Way. Listen and take that break. We're back.
India is a fantastic country. It's a growth market. For 20 years of my investing career, I've invested only in India. But at this point in time, there's so much money coming into the stock markets. And we get a lot of call from retired people who might have a small exposure to the stock markets, but they want to take a big exposure to the stock markets through us, which is, so in a way, the low interest rate environment is pushing people towards the stock markets, because relatively you hear your neighbors doing well, right? The FOMO drives you to the stock markets. And the best part about the worst part about the stock market is people only go about talking about their winners. Nobody talks about their losers.
That is what it is, right? But you said you're worried about the new breed of investors that have come through because they've not really seen a bear market. What worries you?
What worries me is, look, my wife is a techie. She does, she runs an organization which teaches coding for kids. One of her teachers, one fine day, she just quit and said, I want to start investing in the stock markets, which effectively means trading. She's in engineering. She doesn't know anything about the stock markets. But it's a very desperate decision that she's taking. And my worry is people are going to put 7, 8, 10 years of their savings at one go. And then they're going to bear the consequences. So I've seen it time and again. I love speaking to people about the stock market experiences. People who have lost money in the past. And you're seeing the cycle repeat this time. So stock market, I say the stock market is pretty raw. This is where our animal behavior comes out. In the stock markets, you don't think rationally. Or rather, at the bottom and at the top, people don't think rationally. What explains that March 2020, people only wanted to own a select few large caps. And today, people only want to buy small and mid caps.
And PSUs.
And PSUs. And such a dramatic transformation in 3 years. It's like people have just wiped their memories clean.
So, someone was saying the other day that everything that didn't work for the last 15 years is working now, whether it's defense, railways, PSUs. How do you justify that?
So, how do you justify that? To be honest with you, to make money in stock markets, you need to be extremely, extremely contrarian. And I have owned a few PSUs in my personal list, and I just bought them, when their IPOs had come, and after the IPOs, I just bought them. And the amount of dividends that I was getting whenever I used to file my, annual returns, I was amazed. You're getting like 15-18% dividend yields. There was too much value at that point in time in this. So you have to be extremely contrarian in the stock markets. You have to be extremely cynic, and you have to be extremely optimistic that anything can happen. Who would have thought that PSUs would be 10 baggers in a year's time? And who would have thought that the small cap index would rally 700% in 3.5 years?
Welcome back. So nursing a cut of about 0.7% on the Nifty and a deeper one when it comes to the mid-cap index. Relatively speaking, by the way, I have to note that banks, second day running, relative outperformance, still negative, the color on the bank Nifty, but the cut is about 0.3% over there. And yesterday, of course, was that big move that we had on this index after a long time. Today, of course, red, but not as bad as the rest of the market. Let's move on and talk about some inputs that are coming in on Coal India. Now, the stock has been, of course, in the news. It's fallen about 10% in the last 3 sessions. This after the company came out and said that there has been a big fall in e-auction premiums. And that, of course, really spooked the street. Our colleague Rachna caught up with Nagaraju Madirala, Additional Secretary of the Coal Ministry, to understand just how the e-auction premiums are playing out from here on. Take a look.
Coal India is diversifying. Coal India is taking a lot of diversification initiatives, including thermal power. We entered into thermal power. They are also looking at critical minerals. We are also looking at PSP and coal gasification. And we are doing a lot of solar and the solarization we are doing. Now the e-auction premiums, now it has correction took place. It was a little abnormal last year. Now it is correction took place. We don't see much pressure. We are both private sector and the public sector producing a lot of coal. This year we are going to probably achieve 1 billion ton as directed by our Honorable Minister. So both private sector and public sector together. Now we need to find alternative uses for coal. Thermal use is there already, but this can be used for other purposes. China is using it, other countries are using it, so we want to find better uses for coal. So CL is in a good place. CL is in a very good place, and they are doing very well, and we are becoming much more environmentally sustainable organization while producing coal. Most of the coal will be transported through railway network, reducing emissions, and we are loading through silos, CHPs. By 2027-28, most of the coal produced by the Coal India will be loaded through silos and CHPs and through railway network.
Okay, well, e-auction premiums have come off, very elevated levels. That is the Additional Secretary Coal Ministry essentially telling my colleague Rachna. But in his words, the company finds itself in an excellent place. Today, of course, it's down 3, and from the recent high, which is about 490, it's lost about 10%, just 3 days back. Look at Z go. 14% cut. That's a massive, and volumes are off the charts on this one today. 165. Srikanth, I think, is still with us. Srikanth, a quick word on this one. Srikanth, are you there? I don't think.
Yeah, correct. Yes, correct.
Yeah. Sorry, on Z, if you have a view.
Yeah, so Z is also falling, and it is consistently forming lower top, lower bottom series. Now we need to see that whether in this current fall it breaks 152 or not. While looking at the volume pattern, I think 150, 155 should act as very good support for the market. So if it doesn't break 150, then we can see one more rebound in the stock. Otherwise, it is better to stay away for the time being. Let the stock decide its own trend, because it is just falling from the highs, and whenever there is a crash, we are seeing good amount of sell-off. So let the stock sustain above 150, then only we can see to it. Otherwise, again, below 150, the stock can fall to the next levels of maybe 130.
By the way, the recovery, the intraday recovery that took place about 15 minutes back is selling off now. So the Nifty is once again moving towards 22,000. The intraday low was 21,998. So we're not quite there, but you can see that fall in the last 10-15 minutes. I just want to mention the railway companies continue to see profit booking bit by bit. So RVNL, IRFC, no deep cuts, down 2 to 3%, but the month-to-date losses are now adding up. So for a company like RVNL, month-to-date in February, it's down 15%, while IRFC is now down close to about 12 to 13%. But it's going to go down as a day where markets see considerable profit booking after 6 days of run of an up move. Today, the markets have given up 160 points in the Nifty, Sensex down 500 points, and mid-caps were bleeding quite a bit.
Oh, yeah, absolutely. Look at the names here. MRPL, we're talking about the larger refiners, IOC, BPC, HPACL, but let's also look at the smaller ones. MRPL's lost about 6-7%. Let's pull up Chennai Petro also if we can. In general, a sense of caution after a relentless rally on some of the oil refining companies. Then you've got stocks like Irida from the PSU space, Z, Prashant mentioned. If you go beyond, Shakti Pumps, etc., lots of mid caps and small caps where the profits have come off today. So these are some of the key movers and shakers. GMR Airports was weak throughout the session, about 5% lower. BHEL, RailTel, NMDC on the PSU list, PFC. So a lot of profit taking, not by a huge stretch or a huge margin, but definitely some money coming off the table. Union Bank stands out in terms of the gainers. They're doing a QIP raising about 3,000 crores. So that's one stock that stood out. Let's look at ABB India. It was in another market, wasn't it? 11% up on ABB India. No volatility and no concern whatsoever. But the rest of the market, yeah, red day for sure.
No, absolutely, red day for sure. I mean, between last, US was down about 0.8% last Friday. Monday was a holiday. Yes, last night US was down 1%. So 2 days, the NASDAQ, by the way, has been down about 2%, right? The last two sessions cumulatively. If as many like Rajiv Jain, Lawrence Belanco, for example, recently put out a report saying that, India's highest correlation is with the Magnificent Seven and the US markets. If that is so, and tech is essentially the one that we perhaps are most in tune with, we've seen a bit of a pullback there. So, that is perhaps at the margin something to ponder over as well. But it's a under 1% cut, all said and done on the Nifty. Of course, on stocks, losses in some cases are sharper, between 5 and 10% even. Well, it's a wrap on this edition of Closing Bell. Thanks very much for staying with us. But Markets Forward is coming up. He'll pick up on all the action in just a bit.